Hello, welcome back to the channel. All right, so today, real quick, we'll be looking at the debt to equity ratio for Zenith Bank PLC. Zenith Bank PLC is a very renowned bank in Africa, not just in Nigeria, and they have received series of awards in the past 4 years. They've been receiving the award for the best bank so far in Nigeria, and that has been a remarkable trademark for them. So today we'll be observing what's the debt to equity ratio of this institution looks like in the year 2023. So a debt to equity ratio is actually a financial metric that compares a company's outstanding debt to its shareholder equity. So it helps assess a company's financial leverage, can also help assess their risk, can assess also the ability to meet certain obligations. So to obtain the debt to equity ratio, it's very simple. It's just to divide the total debt by the total equity, as we see here in the data set. So the total debt for this company was 18.04, let's say 18 billion, and then their total equity, and this amounts are in trillion, so let's take, they are in millions, so let's take note of that. So this will be 18 trillion, and then their total equity was 20 trillion naira, and then naira also. I think I should just do that and change that so you get it clearly. So all right, okay, let's just work with that. Okay, so that looks much better because we are dealing with naira. Okay, so all right, so that's much better. So we can see here that the total debt for 2023 was 18 trillion naira and the total equity was 20 trillion naira. And then relating to the total, which is the addition of both of them, we obtained the total debt in percent, the total debt percent, which is 47%, and the total equity percent, which is 53% of the total money that was put into the business. So, and then the debt to equity ratio resulted in 0.89. Now, what does this actually say? What is this 0.89 actually saying? So to obtain this 0.89, to obtain the debt to equity ratio, we simply divide the total debt by the total equity, and that's how we arrived at this 0.89 for the debt to equity ratio value. So the values for the debt to equity ratio actually sent a very significant signal with regards to the company's financial health. So any debt to equity ratio that is above 2 may indicate high financial risk. So among the things that this ratio reveals are financial leverage. So a high debt to equity ratio may indicate excessive borrowing. So we can consider anything above 2 as high. So it's considered very high if a debt to equity ratio is above 2. Anything from 2 upward is considered a very high debt to equity ratio, and a high debt to equity ratio indicates excessive borrowing, which might potentially lead to financial distress for that particular company. Another thing that it also reveals is that reveals risk tolerance. So a high debt equity ratio suggests a high risk appetite, while a low one indicates a more cautious approach. So which relates with regards to this, we would see where this company, this institution, Zenith Bank, falls. So we would measure their ability when it comes to the debt to equity ratio. So another thing that it also reveals is that it shows the ability to meet obligations. So the debt to equity ratio may indicate either difficulty or ease in meeting debt obligations. So if the debt to equity ratio is low, it means that it is easier for the particular company to meet their debt obligation, and if it is high, then it is otherwise. So now it also shows the capital structure for the company. So if the debt to equity ratio is known, it helps to evaluate a company's capital structure, whether it's overly reliant on debt or on equity. So now a debt to equity ratio of 1.5 and 2 may indicate moderate risk, while any debt to equity ratio that is below 1.5 indicates relatively low risk. So for this company now, Zenith Bank, we are going to look at what exactly their debt to equity ratio looks like. From the graph, we could already tell. So the legend here is telling us that the black part of this pie chart is the total debt that this bank is running on, and then the red part of this pie chart is telling us the total equity that this bank is operating on. So we could see here in a glance that the company is being funded more with the shareholders' equity more than they have been funded with debt. There are some companies, I know of a company whereby the debt to equity ratio was drastically high, and when I took out my time to observe what their profits, what their net profit was for the end of the year, when I took out time to observe what their 5 years net profit was, I saw that in the past 5 years their net profit has been negative, and that is actually disastrous to the health and to the state and the future of that particular company. So it really reduces their credit worthiness, and creditors would not be able to trust them with their funds, and even investors would stay afar from such a company. Now, but for this company, the case is different. We could see that they have the shareholders equity is actually more than the debt. So we could see here in the data set that even the debt to equity ratio is below 1, which shows a financial strength and financial stability, and it shows that they are not too reliant on debt to run the operations in this particular company. So when a company runs more of its operations on debt, it's actually detrimental to the health of that particular company. Yes, they may actually leverage on that, and if they have operational efficiency, they can actually leverage on that, but then it is not actually the best point of action to run a company more on debt. So for this company, we see that 53% of it is being run by total equity, and 47% is actually run with debt. So this is actually attractive to investors, and when investors look at such a company, they see that these people have more total equity, and then they know, okay, it's safe if I could invest my money here, because it also shows that they can manage their money well, and then they also have more of their resources invested, so they will take the business more seriously. So now we see here that 47% is on debt, and then that leads to the equity of 0.89. So what this is actually saying here is that the company is healthy if you're looking at when it comes to their financial health, they are very, very okay if you want to evaluate the company through their debt to equity ratio, because it should also be noted that there are other metrics that could be used to measure the company's financial stance and their financial health. So yes, as much as this company shares a lot, it's advisable to keep it in mind that this ratio is just one among the many tools that is used to assess a company's financial health, and should also be considered in conjunction with other metrics. So that is a very good one to take note of. So because when a company runs too much on debt, it chases it throws off investors, it throws off it actually gives them puts them on a disadvantaged edge when it comes to credit from maybe they want to collect loan or do other stuff. So it is better a company will be in a better shape if the total equity is much more than the total debt. So that's actually all about this. And then, if I must note, I would say that a high debt is actually like cancer to the financial health of a particular company. So if a company is running through, the company is being funded by debt, the most part of a company is being funded by debt, it can serve as cancer to their bone, and they can begin to decay gradually, and then before that company can go into extinction because it will no longer be attractive to investors. So this is a very good place to look at when investing in a particular company or even your own company. It's actually a good place to look at, and all measures to be adopted to ensure that the total equity is greater than the total debt, in order to minimize the risk of running the company, mostly in an economy like Nigeria. So that will be all for this video. Thank you so much for staying till the end. I do hope to see you in my next video, and please do well to like and subscribe to the channel, and then until we see again, thank you.